Ever wondered how giant companies like Apple make billion-dollar decisions? Or how a promising startup in Bangalore, London, or Austin decides it's time to seek funding? What's the financial magic behind their growth and success? That's the power and purpose of corporate finance. Welcome to Money Deconstructed. In this audiobook, we'll demystify the essential principles of Introduction to Corporate Finance, making it accessible for everyone. So what exactly is corporate finance? Simply put, it's the art and science of how companies manage their money. It involves making strategic decisions about where to invest, how to raise capital, and how to ensure the company creates long-term value. But why should you care? For business students, this is a cornerstone of your education, a fundamental language of business that will unlock diverse career paths from investment banking to financial planning. For early career professionals, understanding corporate finance helps you see the bigger picture within your organization, appreciate how your role contributes to financial health, and make more informed career moves. For entrepreneurs and small business owners, this is your financial survival and growth toolkit. From launching your venture to scaling it, these principles are critical for making sound decisions and attracting investment. For the finance curious, it's about understanding the engine of our global economy, making sense of business news, and even improving your personal financial literacy. Over the next hour, we'll embark on a clear journey. We'll start with the core goals and the language of finance, financial statements. Then, we'll explore how companies make crucial investment decisions, often called capital budgeting, and how they fund those ambitions, which are financing decisions. We'll also touch upon managing day-to-day finances, known as working capital management, and see corporate finance in action with real-world examples and future trends. If you're ready to build a robust understanding of how businesses truly operate and make critical financial choices, you're in the right place. To ensure you don't miss out on our future deep dives into the world of money, make sure you subscribe to Money Deconstructed right now and hit that notification bell. Our commitment is to provide clear, actionable financial education. Let's begin. Traditionally, the primary objective of corporate finance is straightforward: to maximize shareholder wealth. This means increasing the value of the owner's stake in the company, often reflected in a rising stock price and dividends. Think of a CEO as a skilled fund manager, entrusted with the shareholders' capital, aiming to grow it more effectively than they could themselves. However, this view is evolving. Today, there's a growing emphasis on stakeholder theory, considering the interests of all parties involved: employees, customers, suppliers, and the community. Companies like Unilever, a UK and Netherlands-based company, with its sustainable living plan, or Indian companies like Tata Group, known for their corporate social responsibility, illustrate this broader perspective. The rise of ESG, which stands for environmental, social, and governance criteria, is also reshaping corporate goals. Financial statements are like a company's medical checkup report. They reveal its financial health and performance. There are three main statements we need to know. First is the balance sheet. This is a snapshot in time. It shows what a company owns, its assets, and what it owes, its liabilities. The difference is the shareholders' equity. The fundamental equation is assets equal liabilities plus equity. As an analogy, think of your personal balance sheet. Your house and car are assets. Your mortgage and car loan are liabilities. What's left is your net worth or equity. For example, for a company like Microsoft in the US, assets include cash, software, and buildings. Liabilities could be loans and accounts payable. Next is the income statement, sometimes called the profit and loss account. This statement tells you how profitable a company has been over a specific period, like a quarter or a year. It shows revenues, which is money earned from sales, minus expenses, the costs incurred, to arrive at the net profit or loss. For an analogy, it's like your monthly household budget. Income from your job minus your living expenses shows your surplus or deficit. For example, for a retailer like Tesco in the UK, revenue comes from grocery sales, and expenses include the cost of goods, rent, and salaries. Finally, there's the cash flow statement. Cash is king. This statement tracks all the actual cash moving in and out of a company. It's broken down into three activities: operating activities, which is cash from normal business operations; investing activities, which is cash used for or generated from long-term assets like buying equipment; and financing activities, which are cash flows related to debt, equity, and dividends. As an analogy, it's like your personal bank account statement, detailing every deposit and withdrawal. For example, an Indian manufacturing company like Mahindra & Mahindra would show cash inflows from selling vehicles as operating activities, outflows for building a new plant as investing activities, and inflows from taking a loan as financing activities. One of the most fundamental concepts in all of finance is the time value of money. Simply put, a dollar, a pound, or a rupee today is worth more than the same amount in the future. Why? Because money you have now can be invested to earn a return. As an analogy, imagine you have a choice. Receive 1,000 rupees today or 1,000 rupees 1 year from now. You choose today, right? You could put that 1,000 rupees in a savings account and it would grow. This leads to two key ideas: present value, or PV, which is what a future sum of money is worth today, and future value, or FV, which is what a sum of money invested today will be worth in the future. For example, if you invest $100 today at an annual interest rate of 5%, in 1 year, its future value will be $105. Conversely, the present value of receiving $105 1 year from now, assuming a 5% discount rate, is $100. And then there's compounding, earning returns on your previous returns. Albert Einstein reportedly called it the eighth wonder of the world. Are these foundational concepts starting to click? Understanding the goal, the statements, and the time value of money is crucial. If you're finding this breakdown helpful, show your support for Money Deconstructed by hitting that subscribe button. We're committed to making finance easy to understand. Now that we have the basics, let's look at how companies decide to spend money on big projects. These are investment decisions, often called capital budgeting. This involves choosing long-term investments that align with the company's goal of maximizing shareholder wealth. Think, building a new factory, launching a new product line, expanding into a new market, or acquiring another company. As an analogy, for an entrepreneur, it's like deciding whether to invest in a new, more efficient coffee machine for your cafe. It costs money now, but will it bring in more customers and profits over time? Companies don't just guess. They use specific financial tools to evaluate potential projects. The net present value, or NPV, is often considered the gold standard. NPV calculates the difference between the present value of a project's future cash inflows and the present value of its initial investment cost. If NPV is positive, the project is expected to add value to the company. If it's negative, it will likely destroy value. If zero, it meets the minimum required return. For example, a US tech company considers developing a new app. The cost is $1 million. Expected future cash flows, in today's dollars, are $1.3 million. The NPV is $300,000. Good to go? Another tool is the internal rate of return, or IRR. The IRR is the discount rate at which the NPV of a project equals zero. Essentially, it's the project's expected percentage rate of return. Companies compare the IRR to their required rate of return, often called a hurdle rate. If the IRR is greater than the hurdle rate, the project is generally accepted. Think of it as the project's inherent earning power. Then there's the payback period. This is a simpler measure. How long does it take for the cash inflows from a project to recover the initial investment? For example, a project costs £50,000 and generates £10,000 in cash per year. The payback period is 5 years. While easy to understand, it ignores the time value of money and cash flows beyond the payback period. It's often used as a quick screening tool, especially by smaller businesses in India or elsewhere. Let's see this in the real world. For a global example, consider Amazon in the US. When Amazon decides to build massive new fulfillment centers worldwide, they are making huge capital budgeting decisions. They'd meticulously analyze the NPV of expected future efficiencies and sales increases against the enormous construction and operational costs. For a UK example, think of AstraZeneca, a pharmaceutical company like AstraZeneca investing heavily in research and development for a new drug. This is a high-risk, high-reward capital investment. They'd use IRR and NPV, factoring in probabilities of success and patent life, to justify the billions spent. And for an India example, look at Reliance Jio. When Reliance Jio invested billions to build its 4G network across India, it was a monumental capital budgeting decision. They projected massive subscriber growth, which represents future cash inflows, and aimed for a strong IRR, fundamentally changing the telecom landscape. These decisions always involve forecasting future cash flows, assessing risks, and aligning with the company's overall strategy. Which of these investment evaluation methods makes the most sense to you for different types of projects? Share your thoughts in the comments below. And if you're gaining clarity on how big financial decisions are made, a subscription to Money Deconstructed would mean a lot. Okay, so a company has identified a great investment project. Now, how does it pay for it? This is where financing decisions come in. It's all about choosing the right sources of funds. As an analogy, you've decided to buy that dream house. That's the investment decision. Now, how do you finance it? Do you use your savings, which is like equity, take out a mortgage, which is like debt, or a combination? Companies face similar choices. Companies primarily raise long-term funds through two main channels: debt and equity. Debt financing means borrowing money that must be repaid at a future date, usually with interest. Examples include bank loans or issuing bonds to investors. The pros are that interest payments are often tax-deductible, reducing the effective cost of debt, and owners don't dilute their control of the company. The cons are the fixed obligation to make interest and principal payments. Failure can lead to bankruptcy, and too much debt increases financial risk. For a storytelling snippet, imagine a UK-based manufacturing firm that takes a business loan to purchase new machinery, expecting the increased output to cover loan repayments and boost profits. Equity financing involves selling ownership stakes, shares, or stock in the company to investors. These investors become shareholders. The pros are that there's no legal obligation to repay the money, and it can bring in valuable expertise from new shareholders, especially with venture capital or private equity. The cons are that it dilutes the ownership stake of existing owners, and shareholders expect a return either through dividends or an increase in stock value, which can be more costly than debt in the long run. For a storytelling snippet, picture a tech startup in India that raises a round of funding from venture capitalists by selling a portion of its equity, using the funds to scale operations and hire talent. The specific mix of debt and equity a company uses to finance its assets is called its capital structure. The goal is to find an optimal capital structure that minimizes the company's overall cost of capital, thereby maximizing its value. This leads us to the weighted average cost of capital, or WACC. Conceptually, WACC is the average rate of return a company needs to earn on its investments to satisfy all its investors, both lenders, who are debt holders, and owners, who are equity holders. It's often used as the hurdle rate for evaluating new projects. A very significant financing event for a private company is an initial public offering, or IPO. This is when the company sells its shares to the public for the first time, becoming a publicly traded entity on a stock exchange like the New York Stock Exchange, London Stock Exchange, or the National Stock Exchange of India. IPOs can raise substantial capital for growth, provide an exit for early investors, and enhance the company's visibility. However, they also come with increased regulatory scrutiny and reporting requirements. Think of recent major IPOs that made headlines. Perhaps a well-known tech company in the US, a fintech firm in the UK, or a consumer brand in India. Beyond long-term investment and financing, companies must manage their day-to-day financial operations effectively. This is working capital management. Working capital is current assets, like cash, inventory, and money owed by customers, minus current liabilities, like short-term loans and money owed to suppliers. As an analogy, it's like managing your monthly household cash flow, ensuring you have enough ready cash to cover groceries, rent, and bills before your next paycheck arrives. Not too little, because you can't pay bills, and not too much, because idle cash earns nothing. Effective working capital management involves balancing several key components. Cash management means ensuring sufficient liquidity for daily operations, while investing any surplus cash wisely. Inventory management involves holding enough inventory to meet customer demand without tying up too much capital in unsold goods. Think of a US retailer like Walmart managing its vast inventory, or an Indian e-commerce player like Flipkart optimizing stock for quick delivery. Accounts receivable management is about efficiently collecting payments owed by customers who bought goods or services on credit. And accounts payable management means strategically managing payments to suppliers, perhaps taking advantage of credit terms offered, but ensuring good supplier relationships. A company can be profitable on paper, but still fail if it runs out of cash to meet its short-term obligations. This is why maintaining adequate liquidity through good working capital management is absolutely vital for business survival and smooth operations. It's the lifeblood of the business. So, how does all this theory connect to the real world you see and hear about every day? When you read news about a company's quarterly earnings, a major merger or acquisition, often abbreviated as M&A, a stock buyback, or a significant investment in new technology, these are all direct applications of corporate finance principles. For example, when Apple in the US announces record iPhone sales and profits, that reflects strong revenue generation and cost management, which you'd see in their income statement. When a UK company like BP invests in renewable energy projects, that's capital budgeting. When an Indian startup like Byju's acquires another edtech firm, that involves complex financing and valuation. Understanding these fundamentals helps you decode business news and make more informed decisions as an investor, employee, or even as a consumer. Corporate finance isn't a static field. It's constantly evolving with technology and global shifts. Key trends shaping its future include fintech and digital transformation. Technologies like AI, blockchain, and big data are revolutionizing financial analysis, payment systems, and access to capital. Think digital banking and robo-advisors. Another trend is sustainable finance and ESG. There's a massive global push for companies to integrate environmental, social, and governance factors into their financial decision-making. Investors are increasingly demanding it. Globalization and geopolitical impacts also play a large role. Cross-border investments, supply chain finance, and navigating international regulations are more complex and crucial than ever. For anyone in or aspiring to be in the financial world, staying ahead of these trends is paramount. Whether your goal is to become a CFO, launch the next unicorn startup from Mumbai, London, or New York, make savvy investment choices, or simply be a more astute business professional, the principles of corporate finance we've discussed today are your foundational toolkit for navigating and succeeding in the complex world of money and business. In this hour, we've journeyed through the essentials of corporate finance. We've seen that its core aim is to create value. We've demystified financial statements, understood the critical importance of the time value of money, explored how companies make strategic investment or capital budgeting and financing or capital structure decisions, and touched upon the necessity of managing working capital for daily survival. And finally, we've connected it all to the real world and its exciting future. Knowledge of corporate finance isn't just for finance professionals. It empowers everyone to make better financial decisions, understand the businesses that shape our world, and achieve their own financial goals. If this audiobook has illuminated the often complex world of corporate finance for you, and you're eager to learn more, please support Money Deconstructed in our mission to make financial education accessible to all. Here's how you can help us grow and help others learn. Subscribe to Money Deconstructed right now for more clear, concise, and actionable financial content delivered weekly. Give this audiobook a like if you found it valuable. It tells us what content you love. Share it with your friends, classmates, colleagues, or anyone you think would benefit from understanding corporate finance. And importantly, comment below. What specific topic within corporate finance or any other area of finance do you want us to deconstruct next? Do you have any questions from today's session? We read every single comment, and your feedback shapes our future content. Thank you for listening to Money Deconstructed.